Hey everybody, welcome back to Investing with Wesley. While doing research for a different video, I happened to notice a couple good different patterns that indicates that the Federal Reserve is basically going to put us into another bear market. Now, I don't necessarily mean this is going to be a recession or a depression because that affects the actual economy and the goods created and sold. What I do mean is strictly for the market. Now, you might be wondering yourself, how could I possibly have spotted this? And I thought no one could predict the market, and that is 110% correct. I'm not saying this is guaranteed to happen. All I'm saying is I've found a very similar version of what we are currently experiencing in the macro trends that took place near the Great Depression. So that's what I want to talk about in this video today. So with that being said, let's get into it. Okay, so what you're looking at behind me here is the S&P 500 on a very, very long-term scale. Now, I've had to convert it logarithmically, so all the way into the past and up until the present all fits on the same screen, but this is the S&P 500 since the Great Depression. You can see that giant significant dip at the very beginning on the far left is the Great Depression, and after it is a small rise. Now, I want to be clear, it is not this Great Depression era dip that I'm referring to is going to come. It is the very next bear market that you could see in the S&P 500. This is one that started at a peak around 1937 and lasted for a couple of years. It is this line right here that I have highlighted that we're going to be paying attention to today. Now, like I said, in this time frame, the market and the macro trends experienced the exact same thing that we are currently experiencing today. And although the saying's true, past performance cannot guarantee future results, and it's not necessarily guaranteed that we are going to repeat these exact same things. Although all of this is true, you can draw a lot of wisdom and a lot of knowledge in looking back in time and seeing all the events that transpired and how the economy and how the stock markets behaved. It'll help you make an educated guess on where the markets could potentially go. So let's go back in time and have a quick history lesson on what exactly happened in this time. Well, obviously the Great Depression happened, and it happened mostly for the same reasons that the 2008 Great Recession happened, except a little bit different. Just like in '08, everyone was taking money out, everyone was getting a loan. Even the ones that couldn't qualify or couldn't afford it were taking loan outs so they could buy real estate. And the exact same thing was happening during the Great Depression or just before it. Everyone was taking out loans to invest in the stock market, not to buy real estate. Because they thought the stock market could just go up, 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 and up forever, everyone was taking out loans until the vast majority of the valuation in the market were due to these loans. And when everyone was over leveraged and no one qualified for a loan anymore to reinvest into the stock market, the valuations in the market suffered, and that caused a massive sell-off, otherwise known as the Great Depression. Now, how the Federal Reserve stepped in during the Great Depression is the exact same way they have continued to step in today. They combated the Great Depression and the falling stock prices in 3 different ways, and they're the exact same ways we see now. The first one was with lowering the interest rates all the way down to 0. Lowering the interest rates down to 0 made it cheaper to borrow money, so people theoretically could take out even more leverage and help prop up the economy. So now you can see the graph I've put on screen is what interest rates were before the Great Depression, how interest rates immediately plummeted all the way down to 0, so the Federal Reserve can help combat this fall in the stock prices. Now, the second thing the Federal Reserve did way back then is quantitative easing. Now, a quick Google search will tell you that the first formal form of quantitative easing came at the 2008 Great Recession. However, it wasn't called quantitative easing way back then, but the premise was basically the same. The premise was that the Federal Reserve or the Treasury would continue to buy debts, thus effectively being the first form of quantitative easing. And lastly, the third way that the Federal Reserve and the government tried to combat these drastic cut in stock valuations was with fiscal spending. Specifically, the government, because all of its debts were being bought by the Federal Reserve, drastically ramped up its spending. Now, when I say drastically, I mean drastically for the time period. Because if you look at the chart of today's dollars, where the government's federal spending as well as the Federal Reserve buying those government bonds, and you see what they were doing in 2020, the word drastically when talking about the Great Depression era spending is completely shadowed. But in this time frame, it was very drastic. Needless to say, all three of these things actually worked because all three are meant to create a boom in the market. And you can actually see this going back to that S&P 500 graph I originally showed you. You see the immediate sell-off of the Great Depression, and then you see that little bit of a boom of it going back up. Now, because of these three ways that the Federal Reserve and government fought the Great Depression, it also created inflation, the exact same thing we're seeing now. And surprisingly enough, it created roughly the same percentage of inflation as well. Back then, the inflation rate was about 5%, and currently we're hovering around 6%. Now, yes, it worked and it did create a boom, but like I said, it also created inflation. Now, ignoring the inflation for one moment, you can also see that this is one of the first times that the government actually took on massive amounts of debt compared to its GDP, not only just because we were battling the Great Depression, but because we were also just about to enter World War I. Either way, though, the debt compared to the GDP was about to get massively increased. As this next chart that I'm about to show you says, you can see that from the market crash of 1929, you can see the debt to GDP ratio was about 16%. But as we went through the years fighting off the Great Depression's effects and then later entering World War I, you could see that all the fiscal spending really added up as our debt to GDP ratio went up to one point of 50%. So the 0% interest rates, the first ever quantitative easing, as well as the increased fiscal spending worked. It brought us to a boom, and then in 1937, we hit its peak. And this is when the Federal Reserve saw its inflation rate of 5.5% not going away anytime soon, so they had to step back in to try and stop the inflation from running away. So they did what a lot of people nowadays are thinking is completely stupid. They raised interest rates. Going back to that interest rates graph I showed you earlier, where you could see the Great Depression dropping it back down to zero, they raised interest rates that little teeny blip at 1937 in an attempt to stop that 5.5% inflation from getting any bigger or running along even further. But notice that they decided to raise interest rates when we fully weren't recovered from that Great Depression yet, and it was only moments before we were going to enter World War I. Now, granted, they couldn't have predicted that we were going to enter that war, but still, we weren't fully recovered from the Great Depression, just like we're not fully recovered from the pandemic now, economically speaking. But because inflation was 5.5% back then, and the Federal Reserve considered it running rampant and they had to step in, just like it's 6% now considered running rampant, forcing the Federal Reserve to step in, even though we're not fully out of a pandemic. I'm under the assumption that the Federal Reserve is going to do exactly what they did back then and what they've done every step along the way, just in a less significant manner. They're going to force a bear market to happen. Going back to the graph of the S&P 500, you can see that this is exactly what they did. They forced a bear market to happen for roughly 3 years. But let's talk about the differences between then and now, because obviously not everything is going to be a mirror image. The first one is that in today's era, the inflation was much larger and spread much more quickly because of so much more money being printed and invested with the quantitative easing and fiscal spending. So what was a long recovery from the 1929 depression to the 1937 peak, we did in roughly a year. If you remember, in 2020, the stock markets completely plummeted and the Federal Reserve immediately stepped in. And I believe by the end of 2020, we were already past our previous peak with all the propped up market assistance that the Federal Reserve was giving us. Now, another difference that I'm under the assumption is going to happen this go around compared to the 1937 forced market crash is that the 1937 forced market crash was when the country as a whole was still very positive and not over leveraged. If you remember that other graph I showed you on the interest rate is behind me now, you can see when the Great Depression actually ended, the debt to GDP ratio was about 51%. Currently, we are over 200% debt to GDP, meaning we are so massively over leveraged as a country right now that if the Federal Reserve is not careful, this dip that they force us into isn't going to be the Great Depression era event that I'm talking about in other videos, but it does pose a very good chance that this new forced bear market is going to be a lot steeper and a lot deeper of a dip than the one that we saw in 37. And that is strictly because of how over leveraged we currently are. I hope you got value in this video. I hope I helped educate you, and I hope I helped you understand that we can learn a lot from watching the market's reactions from the past. If you did get value from this video, please remember to like and subscribe, as it really helps push this channel out. I think my statistics are something like only 5% of my viewers are actually subscribed, whereas the other 95% aren't. So if you're one of that 95% out there, please remember to subscribe and like this channel, because it's free for you, but it helps this channel out massively. Either way though, the choice is yours, and I'll see you in the next episode.